Hello guys, Brad here from The Guided Investor and welcome back to another episode of Hot Money Topics. Now, I'm gonna do this one a little bit differently to the traditional sort of layout. Instead of running through the key indices and what they did last month, I'm just gonna jump straight into the key topics and really gonna try and dissect the key topics and try and explain to you how they might impact your situation. So with that being said, let's kick things off and start with a key topic this month, which we've talked about before, and that is inflation. The latest CPI figures came in at 0.8% for the quarter, which gives us a running annual inflation of 3%. Now, if you don't know what the CPI is, it takes a basket of goods and services each quarter to see if the price has changed and then averages out these figures into a single CPI figure. It's basically a test to see if your cost of living has risen. But what is really interesting is that the underlying inflation rose 0.7% for the quarter, increasing the annual running rate to 2.1%, which is a 6-year high and the first time in the last 6 years that it's been within the Reserve Bank's target range. People tend to put a lot more emphasis on the underlying inflation as opposed to CPI because it strips out some of the more volatile items. Now, the reason why we want to keep an eye on CPI and underlying inflation is because if inflation happens, it's going to have a flow-on effect to a number of areas, starting with interest rates. So if CPI is consistently strong and it looks like it's going to be running above the RBA's target of 2 to 3% on average ongoing, then that's when the Reserve Bank's probably going to put some cold water over the economy, and they do this by increasing interest rates. Now, we haven't actually seen an increase in the official cash rate just yet, and the RBA has still maintained that interest rates won't rise until 2024. But with the CPI figures that are starting to come through, you do question if that's going to hold true or if they're going to start to change their rhetoric. And we're going to find out tomorrow when the RBA meets, because it's the first Tuesday of the month. But there have been some developed countries like New Zealand and Canada which have actually already started increasing rates. And although we haven't seen an increase in the official cash rate, we have started to see some changes in the bond market. So recently, the 10-year bond yield has increased, and this basically means that investors are selling out of bonds because there's an inverse relationship between the price of bonds and the yield. However, what you really want to know is, what does this mean to you? How does it impact your situation? And it can do this in a number of ways. So firstly, if you held long duration bonds in your portfolio, then over the last month, the value of those bonds has probably dropped a little bit. And that's why in our portfolios, we only keep interest rate duration in our defensive component of the portfolio to about 20% of our investments. Secondly, banks use bonds as a means to lock in fixed rate home loans. With bond yields rising, it means that fixed rates will start to rise. We've already seen ANZ, CBA and Westpac increase their 3-year fixed rates. For the majors, the 3-year fixed rates typically now range somewhere between 2.08 and 2.39%. So if you're thinking about locking in a fixed rate, then you might want to do it sooner rather than later. Finally, if this theme does play out, if inflation occurs and interest rates start to rise, then it will start to hit equity markets. Because investors basically ask themselves, what is the maximum return I can get by taking the least amount of risk possible? And so when defensives and term deposits and cash start to pay you a reasonable rate of return again, there's going to be an outflow from those growth assets like equities into more defensive style assets. There are certain equities out there that will hold up better than others. So for instance, value stocks are typically going to outperform growth stocks in periods of high inflation and rising interest rates. And also other asset classes like infrastructure can benefit from this sort of trend. So that's why in our portfolio, we've taken a little bit back on the equity side. We've increased our exposure to alternatives, our exposure to infrastructure, our exposure to value stocks a little bit, and we're basically trying to hedge our bets. So if this theme does play out, then we've got that base covered. But at the same time, we're not getting rid of all of our growth holdings because this theme may not necessarily play out. So there is still this idea that the inflation can be transitory, and that means it's not going to be sustained type inflation. It's basically just here because of short-term supply chain issues. But I think now is the time to sort of hedge your bets and say, okay, am I positioned well in terms of my investments and my debt positions? Taking into account that inflation could be coming or inflation could be transitory. It's probably best to sit on the fence at this stage. Over the last month, you may have also heard talk about the potential for stagflation. This would mean that inflation is high while economic growth rates slow and unemployment is also high. This would be a terrible outcome, but is on the less likely side of potential outcomes. In other news, but still linked to the inflation concept, APRA has introduced tighter lending restrictions. The way these restrictions work is that when a lender is assessing your ability to service a loan, they assess it at an interest rate 3% higher than the current interest rate. And they call this a stress test. Now, the banks have always done this. They used to do it at 2.5%, now they're doing it at 3%, so it's not a huge change. But it will mean that for those people that were looking to borrow up to their eyeballs, well, they're not gonna be able to borrow as much. And the intention behind this is to really slow down the housing market, which has gone through a massive boom period over the last 12 months. So while it's good for house prices to rise steadily over time, because for most people, their house is their biggest asset, the government doesn't want housing to become unaffordable, and they also don't want people to start defaulting on loans if interest rates were to rise. It's also been reporting season in the US with some pretty impressive results. This has caused the US stock market to yet again hit all-time highs. Tesla hit a $1 trillion market cap, which is just nuts. At these levels, we remain somewhat cautious about equities. And so while we've still got equities in the portfolio, of course, we don't go all in or all out, we have started to tilt a little bit more into other asset classes like I talked about previously. But that's it for this episode of Hot Money Topics, guys. Thanks a lot for watching. If you like this one, please give it a thumbs up and I will see you guys in the next one.